and take it to what's going on with retail, because it seems inflation has not fully stopped consumers from spending. Purchases at retail stores and restaurants unexpectedly rising in May, up 0.3% last month to about $686 billion. That's according to Census Bureau data. Chris Versace is still with us, Tematica Research Chief Investment Officer. And I guess this kind of shows what we're talking about. The demand is still there. One thing that really stuck out to me that is just bizarre to me in this report, right? You exclude motor vehicles and gas stations, right? You get a 0.4% increase. You know where the biggest increase came from of all the categories?
I'm going to guess food service.
It's not what you would guess, right? Food service was up 0.4%. Building materials, garden equipment, and supplies up 2.2%. Like, what the what? I don't know I don't really understand where that came from.
Well, I think some of that is seasonal in nature.
I guess
so. And if people are concerned about the housing market with the tight supply, what are you going to do? You're going to do some repair remodel. But when you compare that against what Home Depot had to say, look, where I live, did people go crazy doing projects around the house coming out of the pandemic? Yes. So I wasn't surprised with what Home Depot had to say, because you can only do so much. You can only go so far. But that number is very surprising. But I will say, though, that when I look at the retail sales numbers, I don't necessarily look at month over month, right? I always look year over year. Because when we think about how companies report, the earnings comparisons we look at, more often than not, it's year over year. And there, the headline was up 1.6% year over year. So when we talk about our inflation
that category
conversation,
fell year over year, I should mention.
Yeah. And when we talk about retail sales versus inflation, wow, people are paying more for less, right? And then you strip out everything else and you look at the pure retail number, only up 0.7% year over year. So again, people are paying more, getting less.
So it is about the higher prices, but the thing that I also, it feels like there is still kind of this divide between where sentiment is versus where the spending is actually happening.
More selective, yeah.
How do we look at that divide?
You really got to, as an investor, you really got to pick your spots, right? So like when we pour over the data, like department store sales down 3.5%, right, year over year. So we know that people may not be either shopping there or they may not be buying clothing. And that kind of fits with the narrative that we've had, that people are eating out, people are traveling. You look at the TSA data, people are traveling with, going gangbusters. United just came out recently and kind of attested to that. And you look at food service, up 8% year over year, still strong. So people are choosing and being selective where they spend, but then you flip it around, and when you have a company like Kroger that comes out and said, we're seeing a lot of our higher end shoppers going towards store brands. Again, more signs being selective.
It's about trade downs in the everyday purchases, but not necessarily in the big purchases.
Buying what I want and saving where I can.
So take that then, put this together between the Fed discussion and the retail sales discussion, and tell us what it means for my money and what, and what people should be buying right now.
So kind of the way we look at it, right? Most consumers, like you were saying, are being more selective. Where are they going to shop so they can stretch their dollars? That's going to be your Kroger's, your Walmart's, your Costco's. And I've liked Costco for quite some time, in part because it has a very differentiated business model, right? It's membership driven. And they derive, unlike Walmart or some other retailers out there, a disproportionate amount of their income from membership revenue. And they're continuing to grow their warehouse footprint, right? That means, more members, more membership income. So that's one that I absolutely like.
Any other names here? It feels like it has been consistently about the value play. If we're talking about sort of those everyday items, Costco is one. We heard that from the other big name retailers like a Walmart as well as a Target. I mean, how do you feel about some of those names in light of elevated prices?
So Walmart, absolutely. I mean, to me, one of the things that stands apart with Walmart is it's actually the largest grocery chain in the U.S., right? So people are coming in more frequently, so they can kind of, lean into that. The Walmart, in terms of taking advantage of their everyday low pricing. Target, I think, has a tougher chance. To me, Target's kind of like lost in the middle a little bit, right? Because you've got your dollar stores, right? And you've got your Costco's, BJ's, and the like, and then Target's kind of over here, so it's not, I think they're going to have a tougher time.
I want to ask about another area of the market, not retail, but sort of related to these bigger themes we're talking about, and that's technology, because that is the area that has done so consistently well, the large cap technology. if we're looking at a Fed that may be raising once, maybe twice again by year end in the face of this strong consumer spending, among other factors, what does that imply for tech stocks?
So I think we got to step back a second, right? And I'm sure you guys have talked about this, but it bears repeating. When you look at how the technology market has exploded this year, really outperforming for the NASDAQ, it's only a handful of stocks that are really doing it, right? And it's really driven by AI-related headlines. So whether it's Microsoft, Google, to some extent Apple, Amazon, or NVIDIA, of course, all AI. And every day we continue to hear more news about AI. Even this morning, Google announcing some AI tool that allows people to virtually try on clothing. Right? Kind of interesting, but just the notion that we're continuing to see more of this. But I think your point is well taken about higher rates, because technology stocks typically, they're categorized, particularly small, medium-sized ones, borrowing. So their incremental cost goes higher, right, to do that. So the questions become, okay, now what am I going to pay for this valuation? But at the same time, too, just skirting back to the consumer, we've, $1 trillion in credit card debt with rates, according to the New York Fed, that are the APR rates that are the highest they've ever seen since '94. And they're going to go higher. That's another headwind for the consumer, too.
Are you buying into the AI boom?
Indirectly. So in the Action Alerts Plus portfolio that I manage for the Street, we have a position in Marvell. So the way that we kind of think about it, Marvell is a digital infrastructure play. If we think about AI, mixed reality, augmented reality, and all these other things that are driving this virtuous circle of content creation consumption, AI is just another factor that's going to drive network capacity higher, fostering upgrades to the network.